You're listening to Storage Nerds Podcast, where we unravel the best-kept secret of the real estate investing world, the storage industry. Join the grassroots guru in self-storage, Stacy Rossetti, in insightful discussions about finding, funding, and running these spaces, allowing you to yield the highest returns possible. Get your foot in the door on self-storage and discover how to properly purchase facilities, negotiate with sellers, and close the deal without worries. Start unpacking that investment wisdom with Stacy right now.
What we're going to do is we're going to talk about something that I think is super important. I talked to a couple people today on my coaching call, and they had some questions about this. So I figured I would just go over this topic and, help everybody to try to figure out like what your options are when you do get started in self-storage. And that topic is going to be funding, right? That's what we're going to talk about today is funding, how to fund your deals. Everybody's always worried about the money and where the money's going to come from. So what I figured we would do today is talk about that. So again, thank you so much for coming and hanging out with me today. I'm Stacy Rossetti. I own 11 storage facilities in the Georgia and Florida area. And I have been, and we actually have 4 under contract right now, which is kind of cool. And on top of that, I teach people how to invest in self-storage. And I focus on mom and pop, like get your foot in the door kind of facilities, right? So everybody's got to start somewhere, right? That's the truth. Everybody's got to start somewhere. So I'm here to get you started and to answer all those questions and try to get try to get the fear of getting started out of your mind. All right. Because if I can do it, anybody can do it. Right. If I can do it now, everybody always says that, but essentially it's true. Right. All right, so we have a couple people. Let's see who's saying hi. Okay, so Randy is, he's new and he's been doing multifamily now, and he's looking to invest in self-storage. Well, welcome, Randy. Thank you for hanging out today. And then also Andrew is in Atlanta. Okay, cool. Awesome. I'm also from Atlanta. We don't know each other personally, but we're friends on Facebook. Okay, good. Well, thanks for coming to hang out with us. I'm not new to investing, but I'm new to storage facilities. Okay, cool. Well, thank you for hanging out, Andrew. I appreciate that. And we've got Randy's from Colorado. Okay, good. Anybody else introduce yourself in the chat? Let me know where you're from. Okay, we've got a whole bunch of students on here as well too. We did the 2-day boot camp for storage nerds this past weekend, which was really fun. We did on Saturday, we did find them and deal analysis and onboarding, how to onboard your facility. And then on Sunday we did some management stuff, how to manage your facilities. And on Sunday evening, we did like how to build your brand online, right? Because the truth of the matter is, and nobody ever thinks about this, when you get into self-storage investing, you're actually buying a business. And in the back end, you have to be able to run it, right? It's a business, okay? And so being able to find tenants and manage those tenants is probably one of the most important parts of investing in self-storage. But everybody is always asking, how do I find them? How do I fund them? Is this a good deal? All right. But in the end, really, the truth is it's a good deal if you can manage it properly. That's really it. It's a good deal if you can manage it properly, right? So anyways, all right. So I saw we had somewhere else. Someone showed up. Who was it? Oh, Austin. Oh, good. Austin was there at the boot camp. He said it was awesome. And Margot is from Ohio. Okay, good. Well, thank you for introducing yourselves. I really appreciate it. Okay, so what I'm going to do is I'm going to get into funding, all the different types of bills out there and how you can fund them and what are the best ways to fund them. Okay, that is going to be the topic today. So what I'm going to do is I'm going to share my screen, and then I'm going to just do a whiteboard. Okay, actually, if I wonder, if anybody is on here and listening to me, does anybody know any of the ways that you can invest in self-storage? There are 6 different ways that you can invest in self-storage. And if you've been following me for a while, You probably know all of these or some of these. If you can think of any ways to invest in self-storage, can you put that into the chat? All right, put it into the chat. Now, there are 6 different ways to invest in self-storage. And that's one of the main reasons why I love investing in self-storage, because there's so many different opportunities out there, and people don't really think of all of them. But I want to make sure that everybody knows what those are. So Luther says owner financing is one of them. I got some owner financing there. Raised capital, family and friends investing, community banks. Okay, good. Okay, well, first things first, what we're going to do is we're going to talk about the 6 different ways for you to invest in self-storage. And then I'm going to tell you of all the 6 ways, how do you fund that type of deal? Okay, because when you start getting out there, and I've said this many, many times to my students, when you start getting out there and you start looking for storage facilities and actually talking to owners, which is the best way to find deals, all right? It's not the only way, but it's the best way. When you talk to owners, the truth is like you have no idea what's going to come across your plate. All right, you don't know what type of a facility it is. And so now what you have to do is educate yourself on the types of purchases out there, so that you know when you do come across a certain type of facility, how you should get the funding for that. Okay. And Tim says, I have no idea what you're talking about. Okay, good. All right. So, okay, we're going to talk about the way that the types of facilities that I buy, right? If you are my student, you know what types of facilities do I buy? So I have 11 facilities. What are they? What type? All right, the first one, yes, mismanaged. Okay, good. All right. So number 1 is mismanaged. All right, mismanaged facilities. What this means is that it's not managed properly. All right, that's what it means, mismanaged. So it doesn't have to be dumpy. It doesn't have to be ugly. Now, a lot of them are dumpy and ugly if they've been mismanaged, right? But the truth of the matter is that a mismanaged property equals it's not being properly managed, okay? Number 1. I'm not going to write down everything about mismanaged facilities. I want you to write this down because, first of all, my handwriting is horrible. And second of all, it's better if I just give you the bullets. Okay, so everybody should be listening. And what we need is we need a sheet, maybe Ariel, and maybe you can make this for all the students. It's like a sheet of paper with all the different, Ariel Lynn is our community manager for Storage Nerds, but I'm envisioning a piece of paper and all the 6 different types on there, and then maybe some lines underneath where people can take some bullets, or we could add some bullets on there as well too. And that would be good, and then we can hand that to all the students. So mismanaged facilities. What that means is it's typical, those facilities are typically, I would say 50 to 75% full. All right. I mean, I'm sorry. I would say 75% full or less. 75% full or less. But typically, you're going to find them at 50 to 75% full. Okay. So a mismanaged facility could be an abandoned facility, right? I've actually bought abandoned facilities before. Or a mismanaged facility could be, 75% full. I mean, it's creating an income, but it's not being run properly in the respect that you can value add the property by increasing the rates. Okay. Now, typically in the industry, a mismanaged property is when you ask the owner, is it full or not full? What's your occupancy? And they say, oh, it's about halfway full, or it's at 75% full. That in this industry nowadays is really a gray area. Okay. On what type of financing that you can get. Now, SBA right now is open to funding a mismanaged facility that's 50% full or more. just as long as they know that over the course of the last year, it's been increasing income. So what SBA wants, and if anybody doesn't know what SBA is, I'm going to write this down. SBA is the Small Business Administration, right? And this SBA loves storage facilities, and they love loaning on storage facilities. Okay. Now, SBA typically likes facilities that are income producing properties, which is the next one, right? Income producing, right? Typically, they want an income producing property, right? So now that SBA is going to loan on an income producing property or a mismanaged facility. With a mismanaged facility, they want to have proof of income. So if it was mismanaged if it was so for instance, one of my students bought a facility in Texas where it was a brand new facility that was just done, and the owner built it and then he sold it off. And when my student bought it, there was no income, right? So that's not really per se a mismanaged facility, but it's a facility that doesn't have any income, right? So if your facility does not have income, then it's hard to go to a bank and get a loan. All right. It's hard to get a loan because in the commercial real estate world, everything is based off of income. That's what the banks want to see. They want to see how much income is that facility producing. Okay. If it's not producing any facility, if there's any income, if there's no cash flow, then essentially they're not going to lend on it. But like I said, in mismanaged facilities, it's a gray area, 50 to 75% full. All right. And SBA has typically lent on a mismanaged facility if you can prove that over the course of a certain amount of time, you are leasing that place up and you are creating more and more income, and you can show that it's over time building income, right? So then SBA is more open to renting, because I do have students that are purchasing properties right now where they are 60% full, and over the course of the last year they were not full at all, right? And so then they're just being leased up. So in terms of the student I told you about, that he bought this brand new facility that had no income at all, I mean, essentially what he did is he had to borrow private money, right? He went out and he borrowed private money from one of my one of my lenders, and then they funded it, and they gave him 18 months to lease the property up. And then in 18 months, he can refi it out and with either a bank loan or an SBA loan. So with a mismanaged facility, if it's producing income and it's, in that gray area, you can go to SBA. If it's not producing income, right? If it's a truly mismanaged facility where it's not being managed properly and it's not producing the income that it should be, then you are going to have to find private lenders. That's what I said, right? Private lender. Okay, so private lenders. And private lenders can be somebody that offers to just lend you the money. So for instance, on the one where my student bought this property that was brand new, he bought it for $1 million. And essentially my lender, one of my private lenders, lent him the money for the property. He put $200,000 down, right? So they required 20% down. They gave him a note for 9% interest, and they gave him, $800,000. So it was an $800,000 note at 9% interest for 18 months. All right. So that type of a note gave him enough time to lease the property out and get it all leased up, and then is able to give him enough time to find another lender that will finally loan to him at a regular interest rate after he has got that thing up and running. Okay, so that's what private lenders do. Private lenders are there to lend you money at high interest rates, right? Typically anywhere from, 6 to 12%, depending on your experience and the lender themselves and stuff. And this was my student's very first deal, and my lender was actually very generous and gave him 9% interest, right? Now, you don't want to hold on to 9% interest forever, right? And also that loan was an interest-only loan, right? So they're not amortizing that note over 18 months. They were just like, this is an interest-only loan. Pay me for 18 months. At the end of the 18 months, you're still going to owe me the $800,000 that I lent to you. Okay. So that is what private lenders do. Typically, they'll lend you the money at a higher interest rate for a shorter amount of time. All right. And private lenders are the perfect type of lender for a mismanaged facility. So everybody knows that I buy mismanaged facilities. So that means I have to be privately funded. So I am always raising money. I'm always pitching deals. In fact, I pitched 3 deals in the last 3 weeks, always looking for money for those deals. And so if you want to buy mismanaged properties, then you are going to have to get very, very good at raising money, right? Now, typically in the commercial real estate world, you need to be very good at raising money anyways. But if you want to buy a mismanaged facility, then you have to get really good at raising money. And also, for mismanaged facility, for income producing properties, you still have to raise the money. And when I say raise the money, going and talking to the bank, that's raising the money, right? Raising money doesn't have to be like just private money. It could be also bank loans. Okay. So, but you've got to get really good at talking to lenders and just being open to, asking people for money. And, I've just gotten over the last 10 years, I've gotten over the fear of doing that. Now, mismanaged facilities, what I love about buying mismanaged facilities is that most of the time, I can like 3x my money, right? So I'll buy something, I could buy something for, a couple $100,000. And then in 2 years, it's worth, triple that amount of money. Okay. So that's why I love mismanaged facilities. You can typically do the same thing with a new construction, right? So I put this down here, new construction. There's another way to invest in self-storage, okay? These are the 3 most popular ways, okay, to invest in self-storage. Now, with new construction, you can also go to SBA and get a loan. SBA loves new construction loans, just as long as the facility that you're buying already is producing income and the market calls for a value add of adding new units, right? Or something like this, right? Or the market calls for new construction. They love doing new construction loans. So, and the reason I bring up SBA is because SBA, typically the requirement for a down payment on an SBA loan is anywhere from 10 to 20%, depending on how good the deal is. That's really how commercial lenders look at their deals. It's called asset-based lending. Asset-based lending. So they are looking at the asset to see how good of a deal it is. If it's a home run and you picked up like a kicker, right, then they could ask for 10% down and give you a great interest rate and give you a 20-year loan. But if it's like an okay loan, then if it's an okay deal where they know you're going to be able to pay the mortgage and make a little money, then they may ask for 20% down and only give you a 10-year loan with a little bit higher interest rate. So really with asset-based lending, there's no, you can't say what's the terms of this loan, because it's really kind of just depends on the asset and how much that asset is valued by the bank, by the lender, by SBA. Okay. So mismanaged facilities, you have to learn how to raise private money, right? You have to learn how to talk to other people. Because if that facility is 50% full or less, right, then it's essentially no bank is going to be lending you the money. No bank is going to give you the money. So you got to get out there and you got to pitch your deals and see if anybody wants to give you the money. And so I have right now 3 storage facilities. I have 4 storage facilities under contract. One of them I already have the money for. 3 of them, one of them I think I have the money for. So we have 2 left. All of the ones that I have are all mismanaged facilities. Okay. Now I'm going to post a question to the group. If one of the facilities that I have under contract, it's $1 million property that's making $150,000 a year. All right. So obviously it doesn't sound like an income producing property, right? It's already making $150,000 a year and it's $1 million. And it's 157 units, just over. It's 157 units, it's 20,000 square feet. We put it under contract for $1 million and it's making $150,000. Why would it be considered a mismanaged property? Can anybody take a guess and put it into the chat? Why would it be considered a mismanaged property? Because this deal is a mismanaged property. And even even the ones that were on my pitch deal when I pitched it, if you guys could chime in, if anybody's on here, and let everybody know, why would this be considered a mismanaged property? Does anybody have any guesses at all? Okay. So let's see, we got a couple people in the chat. Let me just click on this. Okay. How full is it? And are the rates at market? Okay. It is 100% full. And yes, the rates are at market. Pretty much. I mean, I could increase them a little tiny bit, like maybe 5 cents a square foot. But yeah, the value add is missing. No. Bad records. How can you pay back 18 months when you don't have long enough records to show? Yeah. Okay, good. I can answer that in a minute. Bad records, maybe not running a website, marketing, accounting. Exactly. Okay, so that is it. Good guesses. The owner only takes cash. Only takes cash. That is what it is. He has treated this facility as a hobby, right? And he has no proof of records. I asked him for his P&L and his balance sheet, and he said, "What's a balance sheet?" He had no idea even what a balance sheet is. Isn't that crazy? So one of the things is that he's saying he's making $150,000 a year, but we have no proof of that at all. So would you buy this facility? All right, would you partner on this facility? So I basically pitched out to the world that I'm looking for money for this deal, but I have no proof of $150,000 at all, right? And the property is valued at $1.5 million. So when we buy this thing, there's already $500,000 in equity in the deal. But essentially what we're going to have to do is hold on to it for a couple of years, I would probably say 2 years. Because as soon as we get this thing, we're going to start making money. But what we need is those records. Like just like a couple of people have posted into the chat, we need to be able to show our P&L and balance sheet to a lender so that we can refi out, right, later in 2 years. But essentially for now, I can't prove that. I don't have anything. So I have to find people to give me money and partner on the deal with me. Okay. So that is also considered a mismanaged facility. And there are a lot of facilities out there like this, a lot of facilities, right? And I call that the hidden market, or I call it the sweet spot. And it takes a lot of effort. It doesn't take a lot of work. It takes a lot of effort to find these facilities, right? Because actually, there are a lot of facilities out there just like this, because a lot of owners, they really treat their facilities as just what they call hobbies, right? And if they only have one facility, one type of facility, then like, what's the big deal? Now, he did have a 20. He said, I could give you my 2020 tax return, but it's definitely not going to show all the money that I made from this facility. And this happens quite often. This is a mismanaged facility. So you have to get good at talking to private lenders and raising private money in order to purchase these types of facilities. Now, this facility is 157 units, and it has 10 acres. So there is definitely room to grow. He said you could put facilities, as many facilities as you wanted on the thing, right? So as we grow, as we need to, we could do phases and grow and grow and grow, which is exactly what he did. And he started out with I think 60 units, and then he added another phase, and it was another 100 units. And now it's time. He's full, and he's been full. It's time for phase 3, which is going to be us coming in and adding units as well too. Okay, and we could add units now, and I could raise the money to go add the units, or I can wait until we have tax returns and then go and get some money from a bank to borrow the money to get the loan. Go to SBA and get a loan, and go to a local bank. Now, with mismanaged facilities, you're not going to be able to go to a local bank to get a loan because they're just not going to do it, right? Income producing properties and new construction. Also, you always want to compare a local bank with an SBA, a big, SBA lender, and compare what the terms are going to be. Because a lot of times local banks have better terms than SBA. And they may require a little bit more down, but the interest rate is going to be a lot better, and the terms of the loan are going to be a lot better, okay? So if you find an income-producing property, or you want to do some sort of new construction, then highly, highly recommend that you talk to a local bank in the area where you want to do it, and get their offers of what they would offer you for their terms as well, okay? And so we have now 3 different types of facilities. We have mismanaged facilities, income producing, and new construction. Obviously, new construction, you can go to SBA or local banks. Income producing properties, you can go to SBA or local banks, right? On all of these, you could always partner and raise the money. So it doesn't have to be a mismanaged facility in order for you to do some sort of equity partnership. You can always raise money and then create a company and go out there and build a facility together, or buy an income producing property together. Okay. Another thing that you could do is you could, let's just say that you could get a loan from a bank. Let's say it is an income producing property, and it has a P&L, it's got the balance sheet, it's got tax, the owners are willing to give tax returns and whatever it is. Because the truth of the matter is I'll buy mismanaged facilities, but I'm not going to sell those facilities until I know I can give 2 years of tax returns at the highest level I could possibly get them to, and my P&L and my balance sheet, because I want to sell my facilities as income producing properties. Right? That's your goal, is to sell at the highest possible value that you can get it at. But you have to be able to show P&L and balance sheets and tax returns in order to do that. Okay, so we buy mismanaged facilities that we can, in the next 3 years, go sell them to somebody else, and get the highest value we can get. So the mismanaged facilities, the exit strategy for us personally, most likely is going to be to sell that facility and then 1031 exchange it into the profit that we make into a better, into a bigger deal. And several of my lenders they just say, please just take my money with you. I don't want the money back, right? And so one of my private lenders, he gives me quite a bit of money, and he does not want his money back. He's just making money on his money. So why would he want it back, right? And so we've discussed, I'm saying, okay, our loans are coming to term. We're going to either, should I just refi you out and pay you the money back, or what should I do? And he's like, I don't want my money back. you need to, if you're going to sell it, then you need to take my money with you, and we're going to use that as a down payment or something like that, right? So, so once you start getting into the private lender world and truly learning how to raise money, this is really what happens, is that you create these partnerships that are win-win situations for everybody, and then they just want to stay with you. Okay. Now, some of them will want the money back, which is fine, but some of them, they just want you to keep working their money. Okay. And so income producing properties, you will get a P&L and a balance sheet. You'll get like all the things that you need in order to be able to, sell it at top dollar. You will be getting that. Okay. So good. So I'm going to go, like, before you move on to the next thing. Did I just click out of that? What did I do? That's what I'm saying. Like, no, there's no bank. I mean, he has nothing to prove that he's making 150 grand a year. Except for all we have to go off of his word. And the truth is when I buy mismanaged facilities, I'm going off of people's word, right? And a lot of times they're lying to you, right? So he says he's making 150 grand. And so we're assuming that, all of the units are full. Everybody's full. He tells us, we see his prices, so. And so we know he's making money. So maybe he's making 100 grand. I don't think he's 50 grand off, but maybe he's not making exactly 150 grand. But he did kind of write everything out for us. And he said, like, this is what I'm making and this is how it is. And so when they do stuff like that, like, he's like, I have nothing to show for it, but this is how it's working out for me, kind of. So we kind of take his word for it. But at the same time, we just know that maybe there's a little bit of like leeway in this, that we're not making that much. In the beginning, it takes a couple months to get everything up and running and for the income to come in anyway. So, but I mean, and I'll be partnering on these facilities. I'll be partnering on this one. So there will be no mortgage, which is one of the things that I love about partnering. In some situations, you partner and you could just do like a 50-50 split, or you could do like however you want to partner, and then you have no income, or you have no mortgage on the facility, right? So we have like partnerships where we partner, and then we'll manage the asset and they'll bring the money, or or something like this. And so then we just partner based on how we work the terms out. But I like partnerships because you have no mortgage. All right. So all that money every single month just flows back into the company. And then you build up this kind of reserve is what you do, right? You build this reserve up. And then on a quarterly basis, you pay your partners out, right? You pay them out. So now let's just do partnerships. So you could do equity split, not split. And then you could do like asset management. I'm going to just write these out so y'all can kind of get an idea. Or you could do equity split, asset management, or you could do preferred return, or you could do debt. Now, there's probably a million different ways, but these are the ones I can think of off the top of my. This is the stuff that we do off of the top of my head. Okay. So in the partnerships, essentially the way it works is like somebody will say like, yeah, I'll bring like 50 cents. I'll bring 50% to the table, and you bring 50%, and then we partner, right? Or I'll bring 70. I'll bring 20%, and you bring 80%, or whatever whatever the structure is, and then we partner. Okay, and you just however the partnership works, you'll work it out in your operating agreement. And then you'll just get, paid out on a regular basis for all the net income. And on the back end, when you sell the property, you get paid out based on that split, and you distribute to the partners that way. Okay. Based on the profit. Okay. That would be like an equity split. And the percentages could be just like any percentage. All right. In the world. All right, depending on how much you want to give. Now, a lot of times, like when you do a loan with a bank, I've done this before too, where like the bank, I'm gonna say like, I'll put some money into your deal. Like I'll partner with my students on their deals. And I'll say I'll put some money into the deal. What's the percentage that the bank offers? That means that I don't have to guarantee myself on the loan. And it's typically anywhere 19% or below, depending on the bank. It could be anywhere from a couple of percentages to 19%. And every bank is completely different. And so my students will do is just talk to the bank and say like, okay, like, I have somebody that wants to put some money into the deal and just get an equity split. Like what's your threshold on that? Like, what's your percentage so that they don't have to guarantee the loan? And they'll say 5% or 10% or 15% or 20%, whatever the number is. They'll tell you what that is. And then I know, okay, I could put this much in and this should be okay. I don't have to worry about like me being part of the deal. I'm just like somebody that puts money into the deal. Okay. Now, obviously you couldn't be like, okay, everybody's going to put 5% in and then we're going to put like 100 people in. You can't do that because that's really like pooling money. And the banks aren't going to allow you to really like take a loan out if you have like 20 people doing 5% or something. Right. So partnerships are typically like, 50-50, 60-40, 70-30, 80-20, 90-10. And, or like, and then you'll have a couple of people that put like a little bit amount of money or something. Personally, that's what I've seen, right? Now, if you want to start pooling money in, you want to get into like, funds and stuff like that. Okay. Like you have to really register yourself and start a fund if you want to pool a whole bunch of money together. But partnerships are okay. So partnerships are typically a couple of people that get together and like buy a property together. Okay. So that is an equity split. That's equity split. And you will have an operating agreement that spells out the terms of your partnership, who's responsible for what, and and then like, what's your exit strategy and things like this, right? And you could be like the person that's like, in the deal that's like, no, I want to be the one that's like managing everything. You could be the asset manager, and you could say like, look, I'll manage this asset. And, I want it for managing this asset, I want to get this much money. And we do this on a couple of our deals. We're essentially asset managers, and we'll get a percentage of the deal for managing the asset. And then they bring the money in. That's the asset management too. So if you know somebody that, if you know people that have money, y'all could just partner and be like, look, you bring the money in, I manage the asset, and then I get a cut of the deal. How's that? That's asset management. And then, right. So then in the equity split, you would spell it out. You would spell it out in your operating agreement. And also, in all of these, you would have an operating agreement, and everything you would have an operating agreement. But essentially the way that you would spell it out would be a little bit different. So you can do asset management. And typically we're not asset managers. I mean, we manage our own assets is what we do. We manage our assets. But there's a couple of deals that we have that we're looking at right now. I mean, that we're working on and looking at right now, where it's like you bring the money and then we'll get a cut of the deal and we'll manage everything as well too, right? And especially if you don't want to put any money to the deal, because I typically don't put a lot of money I don't put any money into my deals. So I'm okay with saying, look, I want to own this asset. I want to be a part of this asset, but like, I'll just get a cut of it because I know I'm going to be managing it. All right. That's asset management. And then also another thing that you could do too, and the way that you figure this out is because your partners or your lenders, the people that you talk to, they all have different risk levels. Everybody has a different risk level. Everybody has a different amount of money. I talked to one person, I talked to a couple this past week that has $700,000, and they're trying to figure out what to do with their $700,000. And, then I talked to another person that's $60,000, so it's like, and I have like some lenders that, they just like want a partner, and some lenders, they want to have a lien on the property, and they want to just be like a lender, like a true lender. Right. So you have to figure out when you talk to your partners, like what their risk level is, what their exit strategy is, what is their goals, what is their outcomes. Okay. Now with the preferred return, like I have one person that I'm partnering with that he would rather get a return on his money than have like a split in the deal where he gets like money, like, like an equity split. Okay. So what we did for him is we like gave him, an interest rate on his money, a certain interest rate on the money that he put into the deal, and then a smaller equity split. Right? It's a preferred return plus the equity split. which is kind of sort of like what our fund does, right? Our fund is really like, in our fund, when you start a fund, you become an asset manager. That's really what it is. You're an asset manager. And then we'll get we offer for our fund a preferred rate of return and a split in the deal, right? And then we get a cut as well too for managing the assets. So, so the preferred return is for somebody that's it's conservative, but also a little bit open to the equity partnership. Right. So whereas I said debt is I have lenders that are no, I just want to have debt I just want to have a loan on the property. I want to be first lien on the property. I need that security. I want to make sure if something happens, my money is safe and I can get that property. Right. And I just need that. I need that lien on the property. Right. So I have people like this. I just want the lien on the property. And then they just lend me money and then I pay them on a monthly basis. All right. And either interest only loans or sometimes amortized loans as well too. Right. But they just want that lien on the property. And then with the preferred rate of return or the asset management or the equity split, essentially you're creating an operating agreement depending on what the terms are that you come to negotiation with. And then you are partnering on the deal. Okay. So we have now mismanaged facilities. We have income producing properties. We have new construction. We know that we could go to SBA for most of those types of deals. We could go to local banks for income producing properties and for new construction. And then we can learn how to raise money and find partners on our deals as well too, for all of the different types of deals. One of the things that we didn't talk about on here was the owner financing, and I'm not going to get really too deep into that, okay? Owner financing, because I've done many different sessions on this that, my students, you can go into Coach Accountable and you could watch this. There's a lot of sessions out there in the world on owner financing, but essentially owner financing means that you can get the owner to be the bank. They finance you the terms. And they can have a note on the property or not a note, right? They could be completely free and clear on the property, which is a very good indication that they would be open to owner financing, but they don't have to be free and clear. If they're not free and clear and they do owner financing to you, really what that's called is a wrap, right? You can get a wrap on the property, which means that they own a mortgage. It's called a wrap. Okay, they own the mortgage, but then they finance it to you, right? So we could do something like that too, which we've done, right? And on facilities. And I love owners that understand these concepts. I mean, honestly, I just love owners like this that are open to stuff like this. So, and you have to have a really good title company or attorney that understands this as well too, right? So finding really, really good attorneys or title companies that understand this, if you can find a good attorney or title company to help you close deals like this, man, you have a gold mine. They're worth whatever they charge, I'm telling you. And essentially with land trusts and owner financing and partnerships, and if you find an attorney or a title company that understands these concepts, then it's a good partner for you in your business in long term, right? Those types of, I consider my attorneys and my title company people that I work with to be partners. And in fact, we found one in Florida when we closed our deal, and I was like, man, I'm never gonna let this guy go. He's gonna close all my Florida deals. Typically I say find a local person to close all your deals, but this guy was just phenomenal in closing our deal. His organizational skills is not to par, right? But I think everybody right now, over the last couple of years, has been a little crazy. But he knows how to do creative deal structuring, right? I'm talking right now about creative deal structuring. That's what I'm talking about. If you can find an attorney or a title company that understands the concept of creative deal structuring, they can really help you to like come up with terms for your deals too. Anyway, so owner financing or a wrap, right? So owner financing is free and clear, and a wrap would maybe be if they have a mortgage on the property. Okay, and owner financing just means that they're the note. You do not. I mean, they're the lender. They do the note. You get the note with them. They don't do the note, but like essentially, you get a note from them. I guess you get a note. Yeah, you get a note. Like you sign their note, and then they would get the lien on the property, right? It's just like a bank. I mean, it's exactly like a bank, except for guess what? We can be banks too. Awesome, you know? And so owner financing is another tool in your toolbox that you can learn how to do in order to fund your deals. I love me some owner financing. In fact, I'm buying a property right now. It's 217 units. And the owner is owner financing it to me for 20% down. It's $1 million, 20% down. And then 800,000. He's going to finance $800,000 for a 20-year. I'm sorry, it's a 10-year note, amortized over 20 years at 5%. And he wants $200,000 down. So where am I going to get the $200,000? Guess what? I'm going to partner with somebody, and we're going to come up with an operating agreement. They're going to bring $200,000 for the down payment, and then we're going to split the deal. So I don't put any money into that deal at all, right? But I'm going to be the one that manages. I do all the work. I find all the deals, right? So I should get a good cut on that, right? You know, it's a win-win situation for all of us, for the owner, for the partner, and for me. All right. I don't know about my husband because my husband's going to take it over and start managing this. So, but I guess he's part of the family. So we'll have him be a win-win situation as well, too. But anyway, so owner financing is another great tool in your toolbox. Okay, so really learn how to take that concept to heart. Okay, now we still have the last 3 types of ways that you can invest in self-storage. One of them is conversions. And you know this is going to be more and more popular because guess what? All these retail buildings and stuff, they're all going to be for sale because guess what's happening? Retail space is going to be hurting over the next couple of years. I mean, so getting into like these big malls or like these kind of like this kind of stuff is going to it's going to be hard to it's going to be hard. It's going to be it's good for us because they can come in and they can, we can come in and we can buy them and we can convert them into storage. But it's really going to be hard for the owners, man. They're all sitting vacant. Y'all all know that y'all all seen these vacant malls and like these vacant like warehouses in the downtown area and this kind of stuff. That's conversions. And so keep your eye out for some really good deals on some buildings because that's going to happen over the next couple of years, and you can convert those into storage. Now, typically, these types of buildings are kind of expensive, $1 million plus. Actually, I think a lot. I've seen like $450,000, $500,000 like malls and like maybe secondary to tertiary markets that are all going vacant. So you might be able to find like a good deal kind of out maybe in the secondary to tertiary market. But but typically it's going to cost a bit of money to buy these buildings, and then you have to convert them into storage. And it's not that you can't do it. It's just that it's going to take a little bit of money to fund that. So that in these types of respects, you have 2 to 3 different ways to fund those. One of them is syndication. Right? So everybody hears this word syndication, which is basically taking one deal and then getting out there and pitching and trying to partner everybody together and put them together to fund the deal. How many people do you have in that syndication? I would go through like a syndication, like a company, like an online company, like Blue Ocean or something like this, where you can syndicate, you can like pitch out to the world if you need to have more than a couple of people in your group. So if you want to do a conversion, it's going to cost like $4 million, and you could really syndicate that out. A lot of multifamily people do this, and I'm sure you guys have multifamily. There's people on here that are doing multifamily, but like syndication is one of the ways that you can do conversions. And there's a lot of opportunity out there. And the truth is that there's really not enough storage facilities in secondary and tertiary markets. Now, primary markets, oversaturated, right? But we're not talking about primary market. Let's let all those hedge funds and REITs and everybody else, let's have them all have that area, right? We're talking about secondary and tertiary markets. There's a lot of opportunity for conversions in these areas. So if you're one of these people that are like, yeah, I can get out there and raise a couple $1 million, then definitely look into conversions. It's either going to be, for you, it's going to be conversions or new construction a lot of the time. Let's see what else I can say. Oh yeah, so conversions, or you could go to SBA, or you could go to like local banks as well too, for that type of a facility, okay? And then also another way to invest in self-storage is wholesaling, right? Wholesaling is where you're the middle person between the buyer and the seller. And I've done many, many sessions on this out in the world where everybody can find what wholesaling is. So I'm not getting into that. Wholesaling is essentially where you're the middle person between the buyer and the seller. You put them together and you get a little bang for your buck in the middle, okay? So you really don't need money for wholesaling. If you stick to, like, essentially what happens in wholesaling, like you stick to smaller facilities and you wholesale them to like first-time buyers, types of people like me that get out there and buy like smaller facilities. Or if you happen to come across a facility that's a bigger facility, you're like, okay, this person wants to sell, it's 300 units, he wants to sell for $2 million, and I know I can make $100,000 on this thing, if I went out and sold this thing to somebody else. So what you could do, and this is what we do for like our acquisitions person, on the bigger deals, right? On the bigger deals, you just get a little equity cut in the deal. Okay, you could ask, like, look, you don't have to give me $100,000 for this deal because I know it's going to be hard to even raise the money for the $3 million. But like, I would like to have a percentage, and it comes back to, remember, those banks and what they allow you to have as a percentage without becoming, somebody that has to personally guarantee that loan. So you can make quite a lot of money by wholesaling self-storage, and either getting a referral fee, getting the cut in the middle, or like getting an equity split on the bigger deals. Okay. That's not really funding per se, but I just wanted to give you an idea of how you could do that in the wholesaling world. And I have like the wholesaling, all this stuff I go over in my course, right? Super simple self-storage. So, if you guys are interested in purchasing this course, this all goes into depth in there. Wholesaling, I have a bonus section for that as well. Okay. And then finally, the last way, my most favorite way to make money in self-storage is lending. I've talked to everybody here about partnerships and how you can work with other people. And ultimately your goal should be to lend, right? Because all my lenders are making so much money off of me doing nothing except for just lending their money out, right? So everybody's goal in the end should be to lend their money out. My personal opinion, that's what our goal is going to be as we get older and older, and all these facilities that we have, we will be either we will make money, lend that money out, 1031 exchange and partner, or will owner finance them and, be the one that just lends the money out, partners with everybody else, and then sits back and enjoys life, right? So that's going to be your ultimate goal, lending. Okay. All right. So that is it. So I'm going to stop, stop share. And let's see if we got a couple of questions here, and then we'll end the evening. So I appreciate you guys hanging in there and listening to my rambling on funding. We have lots of open strip mall space for rent, not for sale. Is it worth it? No, I wouldn't do the rent. I wouldn't do the renting. Okay. I would just do the purchase. If you don't own that space, I think my personal opinion. Now, there are some people out there that rent the space. So I've never done it, and I don't really advise it, but I would talk to some people that do that. So that might be a great question to post in our Facebook group, which is called Super Simple Self Storage. So make sure everybody is joining that, part of that group and like posting questions like this in that group so everybody can chime in. Okay. And okay, good. And let's see, any other final questions? I don't understand. There's a lot of chatting up here. So just want to make sure we didn't get anything. Okay, good. I don't see anything else, but I appreciate you guys hanging in there about learning about funding. Arielyn has posted in a lot of links to us. This will become a podcast. This will go on YouTube. And you can check out storagenerds.com. The doors are closed and they won't be open again until May of this year. But in the meantime, if you want to learn how to get started in self-storage, I would check out my course, which is called Super Simple Self-Storage. And that is where it'll get you started. All the stuff I talked about today is in that course. Okay. All right. I appreciate you guys hanging in there, and I will see you at the next session.
Thank you for joining us for this episode of Storage Nerds. Hope this informative conversation inspired you to go out there and jump into this highly profitable business venture that people rarely talk about. Get more tips on storage space investing at www.stacyrossetti.com. Don't forget to subscribe to the show and leave a rating. Together, let's build that thriving passive income one storage space at a time. Until next time.